What's going on, everybody? Liam O'Reilly, Vermont economic realtor with Jerry Riley Real Estate. Happy Memorial Day, everybody. Hope you're having a great weekend. Thank you to all the veterans out there, and thank you to all the veterans who gave the ultimate sacrifice for this country. It can't be overstated how grateful we are for you, and we're all forever in debt for those who gave their lives for us. Moving on to the video. We're talking today about the Federal Reserve and their balance sheet, what is going on with the money that they're losing and that they continue to lose, how they continue to roll off their balance sheet while paying higher and higher interest to people who keep money at their facilities. We're going to be discussing that and how that affects the overall housing market. So let's get right into it. We're going to look at this chart first, which is the chart of the Federal Reserve's balance sheet. So as you can see, it increased and then stayed flat for about 2014 through 2017. Then they started dropping and reducing the size of their balance sheet, moving into 2019 from 2017 to 2019. And then COVID hit. They jacked up their balance sheet again. They started buying mortgage-backed securities. They started buying treasuries, and they dropped their the rate at their Fed facilities, their overnight lending rate, down to zero, which did a couple things, right? Mortgages, the part of the reason why mortgages were so low is because the Federal Reserve was willing to take them on at an extremely low rate, right? When you get a mortgage for a home, there's always some risk that you're going to default on that mortgage. But the Federal Reserve is not an institution that is built to make profit. It's there to facilitate, it's there to maintain stable prices is their mission. They want to maintain stable prices and full employment. It's something that Jerome Powell said many times in his recent press conferences. So when they did quantitative easing over the past few years and bought a ton of mortgage-backed securities and U.S. Treasuries, it didn't matter what interest rate they were at. So they're at a very low interest rate. Now that they've jacked up rates, right, they're paying more to the people who keep money in their facilities. Their overnight lending rate of about 5% or whatever the Fed funds rate is right now, significantly more than many of the assets that they hold on their balance sheet. So they're paying out more in interest than they're taking in, right? So they've been operating at a loss. At the same time, they're reducing the size of their balance sheet. So they're reducing the amount of income that they have while raising interest rates and increasing the amount of money that they're paying to banks who are keeping money at their overnight lending facilities. Now, when the Federal Reserve rolls off their balance sheet, something else that it does is it takes money out of the system, right? It takes money out of the economy because when they buy mortgage-backed securities, when they buy U.S. Treasuries, they're essentially buying debt, and that debt is due back with interest. So, right, they're putting $100 out into the economy, let's say, and then 110 is due back, and then once that 110 is due back, they're not rolling that over into new debt. So they're taking $10 out of the economy. In this example, for every $100 that they put in, it's obviously interest rates are different, but that's just an example of what's going on. So when the Federal Reserve is rolling off their balance sheet like that, they're really reducing the amount of money in the system. And I watched a video by the Uneducated Economist earlier today that he talked about this really well. And I want to give him credit. I'll link that video in the description so you folks can understand that. But what I wanted to talk about as well is the amount of money that the Federal Reserve is losing. And this is what this chart shows. So right now, over here on the left side, make sure you guys can see that. No, you can't. On my face is hiding it. See the highlighted 62,000? So that's in millions of dollars. So it is about $62 billion that they owe to the U.S. Treasury. If we look at all this income that they've made, right? What this is a chart of the profits and losses that the Federal Reserve has made. So all the profits that the Federal Reserve makes goes to the U.S. Treasury, goes to the government. The most they've ever made in a year has been $109 million, and that was in 2021. Now they're currently, and then when they take a loss, they owe that money back to the U.S. Treasury. So right now they currently owe $62 billion to the U.S. Treasury, and as long as rates stay high and as long as the Federal Reserve keeps reducing the size of their balance sheet, then this is going to get greater and greater, and they're going to operate at a larger and larger loss, which, it isn't sustainable. At least it doesn't seems sustainable to me. If this was a regular company, right, they would be losing money consistently at a very significant basis, $60 billion so far since they started hiking rates. A regular company would go bankrupt, but the Federal Reserve is not a regular company. So how does this affect mortgage rates? How does this affect the money that's flowing into the system? So when the Federal Reserve rolls off their balance sheet, when they reduce the size of their balance sheet, right, like we said before, they're taking money out of the system. They're pulling back the principal that they put in plus the interest that they made, and they're removing that from the system. At the same time, when they operate at a loss, like they are here, what they're doing is they're adding money to the system, right? This loss that they've made is essentially in order to pay out that interest, in order to pay the interest that they've guaranteed through their lending facilities. When the Federal Reserve hikes rates, when you hear that in the news, when they operate at a loss, they still have to pay the companies and the banks who keep the banks who keep their money at the Federal Reserve. They have to pay them that interest rate regardless of how much money their assets on their balance sheet are taking in. So when they're paying banks the amount of money, when they pay banks this interest rate, that is adding more money into the system, right? Okay, so those are two of the factors that are going on. The other factor is the higher rates in general, right? Their overnight lending rate is supposed to dictate all rates, and it doesn't dictate all rates entirely. It's when you look at the Treasury rates right now, if we look at the U.S. Treasury, it's the 10-year Treasury sits at 3.81% as of the end of the day on Friday, which if the overnight lending rate is at 5%, the Federal Reserve would think, the theory would go that the U.S. Treasury should trade at above 5% because the overnight lending rate is one, overnight, two, it's guaranteed. So basically you put your money there overnight, you're guaranteed that return, as opposed to a U.S. Treasury, which is almost guaranteed, but you still have to wait. It's still a 10-year Treasury. There's a lot more time before the full note gets to maturity. And although it's mostly guaranteed, all the stuff that's going on with the debt ceiling and everything that's in the news right now goes to show that there could be a situation where the U.S. defaults on its debt. Although it's very unlikely, the U.S. Treasury is seen as a very liquid asset. It's not as liquid as the overnight lending facility. So when the Federal Reserve raises rates and they keep rates high, what that does as well is it tightens lending throughout the entire economy, right? It tightens mortgage rates. If we look at mortgage rates right now, NEFCU has their 30-year fixed rate at 6.875%, ticking back up to almost 7%. And a lot of that has to do with not only the Federal Reserve rolling off their balance sheet, the Federal Reserve not purchasing the mortgage-backed securities to hold on their balance sheet, right? Because they don't really care what the interest rate is. If they are purchasing mortgage-backed securities, they're happy to do it at any interest rate, and they're not doing it to make a return. Whereas a bank or an individual who buys mortgage-backed securities is going to want a significant return on those mortgage-backed securities. So that is part of the reason why right, mortgages are much higher, as well as other rates throughout the economy, because people who lend money out into the economy, they want to make sure that they're getting a good return on their investment. And if they can get 5% overnight at the Federal Reserve, then why wouldn't they do that? That's risk-free money for them, and it just makes sense. They're gonna make that 5% no matter what. They're gonna add that to their balance sheet. So what's going on is the Federal Reserve, the tightening is restricting lending throughout the overall economy, which is tightening the overall monetary supply. They're pulling money out of the system by reducing the size of their balance sheet, and they are adding money to the institutions and to the banks who are holding money at the overnight lending facility. At the same time, those banks are not lending that money out into the economy like they were. I don't think they're, there's been a lot of headlines recently about concerns in the commercial real estate sector. And part of that has to do with obviously offices and the work from home, but a lot of these higher rates and how that has affected the overall value of properties. But regardless, banks overall are tightening their lending. They're not lending as much money into the real economy as they were in the past. So essentially they can put their money at the Federal Reserve, have a risk-free 5% return. They can put their money in U.S. Treasuries, and the 10-year is significantly lower, especially significantly lower than mortgage rates. But some of the other bonds across the curve are a pretty decent return, and so their incentive is to, in my opinion, is to put their money in the lowest risk asset at a reasonable return, as opposed to pumping their money into things like mortgage-backed securities or commercial mortgage-backed securities or lending on commercial real estate, which might be a little riskier. And so when they're tightening their lending standards, I think what they're doing is obviously it drives rates up across real estate, across the market, because they need a higher return to justify the risk that they're taking as a bank. And banks and these larger institutions are the primary purchasers of mortgage-backed securities. So that drives rates up and further reduces the amount of money in the system, reduces the amount of people who can qualify for these loans. And so how does this affect the overall housing market? I think the housing market and the mortgage-backed securities right now, which dictates, in my opinion, the mortgage-backed security market dictates the overall interest rate in the housing market. And with less people incentivized to buy mortgage-backed securities because of these higher rates and the money that is being pushed, I think, essentially being taken out of the system from the real economy and put into the reserves of banks, who can continuously put it into a safe asset and not put it back into the economy. They don't need to put it back into real estate or into into commercial real estate or residential real estate, or lend it to businesses, things like that, because they have these returns. That is part of the reason of why lending is tightening up and why mortgage rates are what they are today. Now, I think as long as this happens, as long as we have these higher rates, I'm not, I don't know exactly. I would love your comments as to what is going to happen when if the Federal Reserve continues to lose money like this. What is that going to mean for the overall economy? I haven't quite formulated a thought as to what that is going to do. But overall, with the real estate market, I think it's going to keep rates high and keep activity low, because banks and lenders are not incentivized to invest heavily into a riskier asset when they can get a solid risk-free return from the Federal Reserve. So anyway, let me know what you guys think. There's a lot of concepts in here that I'm still formulating, but I hope you guys got something out of this. I hope this made you think a little bit about what's going on with the Federal Reserve, what they're doing with their monetary policies. Leave a comment. I love to know your thoughts. And if you're looking to buy or sell a home here in Vermont, all my contact information is in the description. If you're looking in another state, I'd be happy to help you find a great realtor. Feel free to reach out to me directly. Other than that, enjoy the rest of your Memorial Day weekend, and I'll see you guys in the next video.